So first of all, thanks a lot to the entire team of accepting the paper and for allowing me to kind of kickstart this August series of online Zoom seminars that we have. So this is joint work with Valerie, Marty, and Davide, which probably most of you know, who are also online. It's actually the very first time that I'm presenting this paper, or that any one of us is presenting this paper. So they're here to make sure that I'm not saying anything silly in case this goes wrong. But anyhow, so this paper is about, obviously about sovereign risk, which has been kind of on my research agenda for quite some years, and which I'm still keep excited to be working on. And so essentially, this particular paper goes back to an older research question that kind of is interested in trying to understand how fiscal capacity might actually impact sovereign default risk, or kind of how it kind of relates to it. And so I think it's kind of a fairly old question. It's a question that has been revived quite significantly during the last global financial crisis, when many governments had to increase the debt levels to bail out their economies, and in particular also during the sovereign debt crisis that occurred in 2012. So and we kind of felt that the current pandemic, despite its unfortunate nature and kind of its unfortunate implications for many people, we felt that it actually presented quite a unique opportunity to shed some new light on this question. And so I'm trying to convince you, as Dimitri just said, that it's actually not only about COVID, but that it actually allows us to to show some light on this. And hopefully we'll have some interesting debate about this afterwards, after the talk. All right, so let me start with kind of some facts. So we're talking about fiscal capacity. And if you actually look at levels of public debt in advanced economies, they have kind of reached record highs that we have not seen since World War II. Now, I think the Economist has consistently been writing about this over the last couple of months. But also, if I just want to kind of put up a statistic from a research paper by Pierre Jarrett, who's kind of been talking about this in the Journal of Economic Perspectives. He's been showing here kind of just a trend line of public government debt to GDP, how that has been growing since the 1960s up to kind of about 10 years ago. And so I think what's very, very obvious is that, well, here for these particular countries that you look at, but also kind of any other country that you would look at, whether it's an emerging economy, whether it's a developed economy, you actually see quite kind of a big trend line upwards, which suggests that kind of debt to GDP ratios are at these record highs that, again, we have not seen since the World War II. Now, obviously, this kind of raises a number of questions, and in particular, also kind of how kind of are these trends continuing? And I think it's quite obvious to everyone. I don't need to kind of to motivate this too much, that the current pandemic that we're in is actually kind of going to increase those levels to kind of another record high. So just to kind of throw some numbers out there, so I think we've had a number of rescue packages that have been negotiated and been agreed upon in Europe and the US. And so I think in Europe, like the big headline number is the 750 billion euros for the coronavirus recovery fund that was actually just kind of negotiated about 2 weeks ago on July 20th. So one thing here that's quite important is the fact that this debt hasn't been kind of really issued yet, but in particular, the focus of our study is going to be during kind of a short time period from the start of the pandemic to about April 7th. During that time period, none of these kind of fiscal indicators actually moved. So I think that's quite important. We come back to this later. In the US, you have a number that's kind of $2.2 trillion in emergency funding through the CARES Act. Again, that's has been kind of voted on in the Senate on March 25th, so quite late. I think that's towards the very, very end of our sample period. And the second stimulus package is on the way. It has not been agreed upon yet. I think the Congress talked about $3 trillion. How the plan is right now. There's discussions going on. Republicans want to push this back to $1 trillion. But in any case, these are details. Headline numbers suggest that these debt levels are kind of going to increase even further. Now, the question, of course, is we're talking about public debt levels. We're talking about fiscal capacity. So the big question is does it matter? Does it have any implications of any kind, either in a positive way or in a negative way? I think there's quite a bit of debate out there. And so one potential implication is, of course, perhaps has a more negative connotation, is that of a potential rise in sovereign default risk. And that's going to be the key focus of this paper. So in particular, I think we have a number of lessons from, in particular, emerging economies as well as from, I think, after the World War II, when various developed economies, which just kind of had amounted massive amounts of debt to finance the wars. And I think there's lots of anecdotal evidence that kind of high debt levels are at least associated with kind of heightened default risk. Again, so here's a statistic that I'm just kind of pulling out of work from Rainer and Rogov, where we actually kind of, what's plotted here is a GDP-weighted percentage of countries in external default or restructuring for the past 200 years. And again, you see in particular periods that are associated with wars have typically seen an uptick in sovereign default risk. But we don't even need to look that far. I think just kind of the recent sovereign debt crisis with Greece defaulting and the number of bailouts that would most likely have been a default had there not been kind of support from the European Union also suggests that, again, there seems to be some association with fiscal capacity and sovereign default risk. Now, you might more generally ask, why do you even care about all of it, like studying default risk? Well, I think it's kind of fairly well evidenced that this might have major implications for various economic quantities and crises. In particular, Reinhard Rogov and Roman Romar have been kind of putting forth the issue that, well, if you have high debt levels, it might actually be associated with much lower economic growth and output. Jordan co-authors have also kind of argued that, well, it's in particular kind of when you have a big bust and countries have higher public debt levels, well, the actual recovery in the private sector might be much lower. I think the recent global financial crisis have significantly highlighted the fact that the financial sector might be particularly impacted when they actually hold government bonds, especially, which can lead to kind of the very famous sovereign bank doom loop, and kind of pointed out quite a bit by Acharia and co-authors. And also, again, just beyond the financial sector, that also like there's lots of evidence that an increase in default risk might actually also affect the real economy in various dimensions. But it's not obvious that this is always kind of bad. I think there's kind of substantial debates that argue that maybe the public or the social costs of high public debt levels are not that high after all. So I think going to these debates, probably one of the kind of the most kind of well-discussed debate in past talks, but also kind of in past years, is the presidential address by Pierre Blanchard in 2019, where he actually argued that we shouldn't care too much about these high debt levels as long as kind of our nominal growth rates of the economy are kind of above our borrowing costs or kind of our nominal interest rates. And so that has often been kind of an argument for pushing the view that, well, the debt levels don't matter. We can simply roll over our debt consistently, and in the long run, we're just going to grow ourselves out of debt or inflate away. I think another very famous kind of debate that relates to those issues is kind of the spat between Carmen Reinhardt and Ken Rogov against Paul Krugman, where generally I think the whole evidence that high default risk might be kind of associated with low economic growth is kind of quite debated, in particular because, well, the debt levels might just be a consequence or a reflection of poor economic growth. And so the huge challenges that we face are effectively kind of a problem in identifying a causal relationship. And again, that has been kind of, has led to kind of quite substantial skepticism and therefore led to kind of issues or debates around are there social costs to the level of public debt. Now, this leads me kind of to this paper, and I think kind of, I think afterwards I can stop to take some clarifying questions. But in particular, what we after the research questions that we have in mind in this paper is trying to understand the role of fiscal capacity in kind of in modulating the relationship between external shocks to economic growth that a country might face and how that impacts sovereign default risk. So in particular, kind of we felt that once the pandemic was starting, that this is a particularly unique setting to address that question. And that's for various reasons. So one thing is typically if you think about, well, the starting point, like a shock to economic growth, you need kind of a good proxy for that. And in particular, in principle, you would like to have a proxy that's measurable at very high frequencies. Now, probably in our view, a very good proxy that has been quite different across countries and it's also kind of been staggered out over time, so starting at different periods for different countries, is simply the number of infections of the coronavirus in each given country. So the good thing is that it's measurable. It's fairly kind of measured in the same way across kind of the various countries that we kind of have in our sample. And there's also kind of, it's measured on a daily basis. So kind of to some extent to a first order, there's kind of a good proxy for shocks to economic growth. On the other hand, you want to have the impact kind of variable, which is kind of the sovereign default risk. And to no surprise, kind of also, I think that to many of you, I've been working for a while with CDS premiums, so prices of insurance contracts that protect you against sovereign default. So even like the same with these, they're measurable on a daily basis at high frequencies, right? And they're kind of very comparable across countries. The third aspect that we need kind of, if you want to understand how fiscal capacity kind of fits into this equation, is essentially a measure of fiscal capacity. And importantly, kind of fiscal capacity here is predetermined on an ex-ante basis. So while infection rates at a country, on each country, as well as kind of measures of sovereign default risk, evolved very rapidly and very frequently within a short time period, measures of fiscal capacity were essentially predetermined and did not change within the period of our study. I think that's kind of quite an important aspect. The last point I think that's very interesting, as I'm going to kind of elaborate this in a second when I get to kind of some of the statistics, is that the amount of heterogeneity that we have in the spread of the coronavirus, as well as in kind of the dynamics of CDS insurance premiums, is extremely rich. And I think it's this kind of this large cross-country heterogeneity in both the timing and the speed of evolution of the virus that we're trying to exploit to actually tease out that relationship that we have there. Now, just kind of to give you the headline numbers, in particular, what we are going to find is that while fiscal capacity is actually a major amplifier of sovereign default risk when a country gets hit by an external growth shocks. In particular, these are the coronavirus infections that we have. Now, how large is kind of that amplifying effect? Well, if you think about kind of, if you rank countries basically on a distribution from 25th percentile of the most kind of constrained country versus the 75th percentile of the distribution of fiscal constraints, you have an impact where a 30% daily increase in infection rates translate into a 1.3% increase in CDS premiums. Now, this might sound small, but you have to remember that the average daily change in infection rates was about 26%. So on a cumulative basis, in a very short period of time, is actually quite substantial economic number. And let me just give you kind of this graphically, and then I'll stop there to take clarifying questions. But in particular, I think a nice way to kind of to give you the preliminary evidence up front is to do kind of some sort of a double sort. So we usually like in finance to do double sorts. So what kind of double sort are we doing here? We're essentially looking at countries that had a high COVID infection rates and those that had a low COVID incidence. And in particular, again, the ones that had a high COVID incidence is kind of the solid line. Those countries with a low COVID incidence is that with a dashed line. And within each bucket, we do kind of a double sort where we also look at countries with high and low fiscal capacity. And so what you see is in particular, if you focus on this kind of solid black line, right, over the our sample period, what I'm plotting here is the cumulative increase or change, so to speak, in the CDS premiums, right? So the cumulative changes in the prices of this insurance against default risk. We see that in particular, the countries that had high kind of COVID infection rates, as well as those with essentially low fiscal capacity that kind of had a very, very substantial increase in their premiums. And I think this is, a good moment to kind of to take some clarifying questions before I get into the details of the analysis.
So there's only one question so far. It's from Gustavo Schwenkler. He says, I'm assuming that all of these statements about sovereign default risk are under the pricing measure. Is that correct?
So yes, so at this stage, what we're going to look at is obviously it's going to financial market-based prices. So all of this is under the pricing measure, right? So we're looking at basically a combination of expected default as well as a risk premium component. That's correct. Now, we don't have a formal model here kind of to tease out how much of a risk premium we're capturing, but later on, like most likely kind of we're capturing a risk premium effect. And that's also going to be part of, I think, when I get back to the conclusion where I think we can perhaps elaborate a little bit more on those issues.
From Simon Van Norden, should we think of the COVID shock as a transitory fiscal shock, or do we think it has an important permanent component?
Well, I mean, I think this goes back to the whole discussion about the social cost, I would say, right? So I think if you have if I go back to a kind of the big measures, right? So I think the interventions, so this is going to give us a huge level shift in debt to GDP ratios, right? Again, in principle, I would say this could be a permanent effect, but of course, if you have the whole debate about the Blanchard issue where your growth rate is just above your kind of your borrowing cost, then in the long run, right, this is essentially kind of you're growing out of your debts, right? But I would see this as a permanent shock, right? But at this stage, it's hard to say, right? You would need, I think, more of the model to actually be more explicit about those issues.
All right, no other questions right now.
Okay, so let me give you the overview of the talk. So what I'm going to first start to do is to give you a little bit more kind of color around the actual development of the infection rates and sovereign credit spreads during the pandemic. And also I'm going to emphasize the heterogeneity that I mentioned across countries and also kind of in the speed of the evolution of the spread. So then I think I'm getting into the analysis where I'm first going to discuss how we measure fiscal capacity. So I think that's actually quite it's more of an art than a science, and I think it can create kind of a lot of debates, but I think we're going to take one approach that I'm going to be upfront about. And then I'm going to kind of examine essentially this relation between the growth shocks and sovereign default risk as a measure of, as a function of fiscal capacity. We're going to look at endogenous fiscal capacity thresholds in a second, trying to relate it back to all the debates. And in the last step, I'm going to actually start thinking about differences in fiscal versus monetary policy channels. So to trying to convince you that what we're capturing is actually a fiscal channel and not a monetary policy channel. So, all right, so let me kind of give you a little bit more color on what happened during the crisis. So what I'm showing you here is, again, during our sample period, well, in this particular one, we start a little bit earlier, but in this particular graphs, it's from January 1st to April 7th. I'm plotting two things. One is the number of COVID-19 infections per 1,000 people. So it's almost on a per capita basis. And here I'm showing you the cumulative percentage change in CDS premiums. And I'm doing this for 3 different regions. So I'm bucketing all kind of the prices and infection rates for the Asia Pacific region, for Europe, and for Americas. Now we're talking about 30 developed economies here. So I'll get back to kind of the sample, but essentially we're only focusing on developed economies for various reasons. Now there's a few interesting facts here. So the first of one is what kind of the number of infections, so the development of the infection shows is that something that we all know, the virus spread from east to west. So it first started kind of to show signs in Asia Pacific, right? In many Asian countries, that's kind of the green dashed line here. Then it moved to Europe, which picked up, which is the blue solid line. And then in the last part, it moved to the Americas, which unfortunately is now kind of affected quite pretty harshly. Now, if you look at kind of so first of all, the starting points is quite different, but also the intensities. So you see kind of that the Asian countries were fairly quickly kind of able to flatten the curve, right? So kind of have a much milder evolution of these infection rates, versus both Europe and kind of North America experienced actually quite significant increases. If you look at kind of the matched kind of changes or increases, the cumulative changes in CDS premiums, you see again that the starting point of these increases, they coincide quite nicely with the starting point actually of the infection rates. But then what you see is actually that the intensity of the increases in CDS premiums don't really line up with the intensity of the infection rates. So in particular here again, what you see is that while the Americas, they were actually kind of affected quite widely in terms of CDS premiums, even though effectively the kind of the speed here, the intensity of the spread was quite significant. Asia, which actually kind of has all the countries that had managed to flatten the curve most significantly, are the ones that are kind of the most penalized in terms of prices. And there's Europe is kind of in the middle, even though Europe had essentially kind of the strongest spreads in the virus. Of course, now things have changed. The Americas are now a little bit more affected. So there's kind of quite a bit of heterogeneity in both kind of the cross-country development of the crisis, as well as in the cross-country development of these insurance prices that are reflecting these measures of sovereign default risk. So let's dig in a little bit more into the actual country level analysis, what we see there. So what I'm showing you here is something very, very similar, but it has a slightly kind of different angle to it. So here I'm looking at actually during our sample period, the maximum number of infections per 1,000 people that we had at any point in time. So for example, if I just focus on the biggest one, Iceland during our sample had the largest kind of intensity of infection rates at some point that was kind of a little bit more than 4 people on 1,000 per 1,000. So four infections per 1,000 people. Versus again, what we reflect here, this is kind of reflecting the same we had before, strongest infection rates or increases in Europe, even though these are maximum values, the lowest ones in the Asia Pacific region, and so somewhat in between in the North America. Now here, what you have, it's again, it's the increase in CDS premiums, so in the prices of sovereign default risk, right? So these insurance premiums, but in this case, it's not the cumulative effect. It's kind of, it's actually the increase from start to the peak before kind of things came down when we had interventions. And so what's very interesting to see, first of all, again, well, you do not see the same patterns as you see kind of in the maximum number of infections per country, but also you see quite some interesting polar opposites. So take, again, I'm cherry picking two specific examples. So if you look at Greece, Greece was actually among the countries that had the lowest incidence of coronavirus infections. But in terms of start to peak or bottom to peak kind of rise in CDS premiums, it was the one that's kind of was most significantly affected. In contrast, if you look at Switzerland, Switzerland was among the countries that was most affected, right? But essentially, Switzerland had hardly any increase in CDS premiums. So these kind of some very striking differences that actually kind of tell us that there might be some very, very rich heterogeneity that we can exploit to actually kind of better address our question. All right, so that's kind of the descriptive evidence. So I'm getting now into kind of the first part of the analysis, which is about measuring the fiscal capacity. And so like I said, what we're going to do, we're going to focus here on a sample of 30 developed economies from the Americas, Europe, and Asia. And the reason is primarily for two reasons. So one is the homogeneity of the, and the second one is the quality of the data. So what we need is, first of all, good measures of COVID-19 infection rates. We need kind of good data on CDS prices for all of these individual countries. And we need kind of good measures on fiscal and economic indicators such that we kind of compare them well across these countries. Well, it turns out that if we kind of go into developed economies, first of all, we kind of have less issues with the quality of data. I think there have been debates about the reporting of testing rates in countries like Brazil, for example, or in Mexico. So I think we believe that the numbers are more trustworthy if we focus on developed economies. And also in terms of the homogeneity of the data, it's just kind of the definitions of how we measure depth and how kind of the CDS contracts are defined. It's just much more homogeneous across these.
Actually, Patrick, before you talk about the details of fiscal capacity, maybe there's one or two questions that I'd like to interrupt you to ask.
Sure.
So actually from Alexander Lee, which is related to a question I had, is that how can Asia be affected the least in terms of infections, with the Americas and the Americas having the most, while the price effect is inverse? And this is actually related to something that I was thinking of, is that the economic shock is maybe not just the infections. It's the combination of the infections and the reaction. Let's, suppose hypothetically some Asian country, like let's say Korea, has a very drastic, very strong reaction to infections, and they close down their economy, right? Mm-hmm. So that the infections are maybe not the shock, but the shock is the reaction to the infections.
Okay, so it's an important point. I think we can have a lengthy discussion around this, and I think it's actually, I'm going to give some answers now, and perhaps if it's not fully satisfying, we can come back to this later at the talk as well. So what we need is the starting point is a proxy for economic growth shocks. So we felt that the infection rates are the closest we can get to some exogenous measure of a shock. Now, in contrast, kind of the global financial crisis that we had kind of a buildup of leverage, et cetera. And so the endogenous buildup of leverage itself led to kind of to the bust, which ultimately kind of created kind of the bubble, and so we had the recession and the fallout of the global financial crisis. The same with the sovereign debt crisis. Here we kind of have the levels of that constant, but we're getting a growth shock, right? We see at least the initial incidence of the infection rates as kind of to some extent were first order exogenous. Now it's clear that the subsequent evolutions of that might be impacted, right, by government's kind of interventions. And so what we would pick up is effectively in that sense from like being more agnostic about this is just kind of the statistical relationship between the actual measures of infections and the rise in sovereign CDS premiums. Now, this goes down to the heart, like, is that the perfect measure of the growth shock, right? So we have looked at other things. We have looked at, for example, death rates, but so death rates are very highly correlated with the infection rates. I think they're kind of, they're lagging. So there's a high correlation, but with a lag in particular. And we also looked at kind of retail traffic, right? So again, it's not a fully satisfying answer, but we looked at kind of like traffic in retail stores as another proxy for economic growth shocks. But again, I wouldn't even kind of dare to argue that even the first incidence of that is exogenous. So we believe that at least the first starting point is kind of to some extent exogenous. And when we run our kind of analysis on different subsamples, we already just have a short period, a window that we look at, but even in shorter windows, we're actually getting kind of similar results that are significant. So I don't think it hinges on particular, but I think it's a very valid point and a very fair point to ask.
All right, so Alexander's question actually inspired a whole bunch of follow-up questions, and there's a big discussion in the chat, but I actually think you don't have time to address them now, so I'm not going to read them to you now. And maybe, you know, there's a lot of people who want to talk about this, but I think we'll defer all these questions until you're finished, because if you take them now, you won't finish.
Yeah, okay. I think that's, so I just kind of want to add one more thing to this. So I think later on, when I actually go into the distinguish between fiscal and monetary policy channels, we actually have a secondary analysis where we look at kind of the same relations within the United States. So we're looking at across states. And I think, again, yes, even there were differences kind of in lockdowns and so forth, but still I think that would kind of to some extent mitigate the concern that people might have. But we can kind of, because within the same economy, but we can discuss this again a little bit more later. All right, so that's what I said. So now, how do we measure fiscal capacity? So of course, that kind of is a significant challenge. And I think there's numerous institutions and academics that have been trying to think about this. We take a similar approach to what has been done in the past, but of course, we're gonna try to kind of add our little bit, our own kind of, adopt our own approach in terms of trying to come up with something different. So what we're going to do, we try to kind of develop fiscal capacity ranks. So we take 6 fiscal and economic indicators that are indicative of fiscal constraints, in particular debt to GDP ratios, government expenditures scaled by GDP, interest expenses, unemployment rates, GDP growth, and credit ratings. And when I get to the states, we also look at unfunded pension liabilities. Now, I'm going to focus primarily, I'm going to show you some evidence for these individual variables, but I'm going to focus primarily on an aggregate rank of fiscal capacity, which kind of is think about this as a weighted average of these measures, which are normalized and just signed such that they all go in the same direction. Now, that aggregate rank is effectively also normalized to be between 0 and 1. So we feel that there's a particularly strong way of avoiding the impact of outliers. And one very good example is Japan, which has more than 200% debt to GDP, but just kind of like to be upfront, all the results are pretty much robust, even if we use the raw measures, right? And also kind of if we look at these ranks individually. All right, so that's our fiscal capacity. So to give you kind of a sense of how this looks like, so these are our fiscal capacity ranks, like I mentioned, that go from 0 to 1. And you see, in that case, the usual suspects here on the right-hand side are Greece, Italy, Portugal, France. Again, I think none of the fiscal capacity measures that you get currently, whether it's from the IMF or from the World Bank or so forth, is perfect. Neither is ours. But I think it's a way that kind of gives you kind of a consolidated view of different constraints along different dimensions of fiscal capacity and of different constraints. All right, so we have measured fiscal capacity. So now what we want to do is to try to understand the relation between the shocks to economic growth and sovereign default risk, and how basically fiscal capacity might play a role in modulating this relationship. So the starting point is kind of getting a reality check at how the CDS premiums are related to the spread of the COVID infections. In particular, the regression specification that we run is kind of to simply look at contemporaneously at the relationship between changes or percentage changes in CDS premiums of a given country, that we regress on the percentage changes, there's a spread of the coronavirus in that particular country. We control for the usual subsets of global and country-specific risk factors. Kind of we add in kind of country-fixed effects, kind of to focus on the within variation, and we try to kind of absorb any time trend using time-fixed effects. Now, the first start is column 1, is basically just a univariate regression that kind of indicates the relation between these changes in CDS premiums and the development in these infections. And so the coefficient here of 0.079 is basically roughly translating into an economic magnitude that says if you have about a 30% change in infection rates, you would have about kind of a 2.2% increase in CDS premiums. Now, again, I think this is economically substantial, in particular because the daily change in infection rates was on average about 26%. So on a cumulative basis each day, this becomes actually quite significant. Now, also just kind of to highlight the adjusted R-square, so it's at 6.5%. Again, in the univariate regression, you can interpret this as the square of a Pearson correlation coefficient. So that's roughly kind of a correlation of about 25%. Okay, so the remaining kind of columns are simply reality checks that we kind of not doing anything weird relative to the existing literature. So first, we kind of control for various common factors that have been documented to kind of be strongly related to CDS premiums. The natural thing is kind of US kind of stock markets are negatively related to CDS premiums. Credit risk factors. We know since the global financial crisis that the local financial risk is quite important as well, right? That works. And if we kind of add our infection rates relative to these individual kind of well-known risk factors, right? Yes, they kind of absorb some of the variation, but this effect remains highly statistically significant. All right, what else do we have? We have essentially also the, if I kind of, in the next column, we add the country fixed effect to kind of focus on the rhythm variation. In the next column, we have essentially the time fixed effects to kind of absorb the time trend. And again, even if you throw in both, you see typically that these effects remain statistically significant. And again, the economic magnitude is a little bit reduced, but overall, these effects are quite important. All right, what else do we have? So what I'm now doing is basically trying to kind of add in the relationship that fiscal capacity plays in explaining the variation between changes in CDS premiums and changes in infection rates. So in particular, what we have is that in the next regression, what I'm adding is the interaction between kind of the spread of the infection rates. So again, these are daily percentage changes in coronavirus infections with the kind of the country-specific level of fiscal constraints. And so just kind of the starting point is the same regression that we had before here, where we essentially have the relation, the coefficient of 0.025. But because something that I omitted in the previous case is that the US is in particular like an outlier in all our regressions. So if you look at here, column 8 in the previous regression, if you allow for kind of a different sensitivity of CDS premiums relative to kind of the COVID infections, you see actually that the coefficient there is negative. And I think that's well known with the US being a particular case, also kind of as a safe haven country. So in all what we do, the US is not undoing our results whatsoever, but on an individual country level, it is actually a particular outlier. So because of that, we actually decide in what follows to kind of take it out. Now, that said, it doesn't really change the magnitude of our results. So again, here column 1 is basically the base result with the US. That's the result without the US. We go from 30 to 29 countries, but nothing really changes. All right, so what I'm interested in is like what I said. So what's the kind of the conditional effects of infection rates on CDS premiums, given that I'm fiscally constrained? And so like I said, we have these 6 measures of fiscal constraint that we can act with: the infection rates, expenditures, debt to GDP, interest payments, unemployment, GDP growth, and ratings. And again, these conditional effects are all significant and go in the right direction. So again, let me just focus on one of them. Again here, if you have more expenditures as a fraction of your GDP or more debt to GDP, well, your sensitivity of your CDS premiums to infection rates is significantly higher than if you're not so constrained. Now, what's interesting is that the unconditional effect in most classification actually loses its significance. So which suggests that there's no unconditional relation, essentially, between infection rates and sovereign default risk. But what we're capturing is a conditional relationship that depends on your level of fiscal capacity. All right, so what I said is kind of our main variable of interest that I'm going to focus on is to try to say, well, let me think about the aggregate value of all these fiscal constraints. So I'm trying to aggregate these measures into one particular index of fiscal capacity. And in what follows, I'm going to use that as our main measure of fiscal constraints. So what I have in the next line, so again, I'm having my unconditional effects of CDS of coronavirus infections, which is mostly insignificant. And I have the interaction of the infection rates with the fiscal constraint measure. And as you see, effectively, no matter how kind of what I'm going to specify, I'm going to get to the other specification, there's a positive effect that's statistically significant, again, suggesting that we find a particular relation between infection rates or growth shocks, if you wish, and CDS premiums if you're fiscally constrained. Now, what's the economic magnitude here? So, well, we can look at the distribution of our fiscal constraints. If you effectively go here from the 25th percentile to the 75th percentile, so this coefficient here would translate into a magnitude of 1 to 3%. So in other words, if you have a daily kind of change of infection rates of 30%, that would translate into a 1% CDS increase for a country at the 25th percentile of our distribution, and at a 3% increase for a country at the 75th percentile. And so essentially these, that gives you roughly kind of the amplifying effect of fiscal constraint. Now, of course, you might be kind of concerned that all that we're capturing is just basically a differential propensity of a particular government to be exposed to the coronavirus infections, right, to the pandemic. And that could be explained by, for example, a healthcare system that's not as developed, fewer number of doctors that you have per 1,000 citizens. It could be the fraction of your population that's obese, right, or kind of old. It could be the fraction or the population density, simply that's kind of related to the spread of the infections. Now, if we kind of try to control for this, or try to kind of interact the number of infections, the spread of the infections, right, with kind of these measures of exposure to the pandemic, well, we'll see again that the fiscal constraints measure is consistently significant with a similar order of magnitude. And again, these do not seem to kind of explain our relationship. The last two columns that I have here are effectively splitting the sample into those countries that are part of the Eurozone, so basically which have a common monetary policy, and into those countries that have that have an independent monetary policy. Now, again, what we see is that the effects work in both subsamples. I'm going to get back to this a little bit later, because in particular, we're trying to kind of use this together with an analysis on US states to kind of tease out whether we're really talking about a fiscal channel or a monetary policy channel. All right. The question, of course, then comes up. So what have we established so far? So we have established that unconditionally, there's no significant relation between the number of COVID infections and your changes in CDS premiums, whereas if you're fiscally constrained, you're very strongly, have a very strong sensitivity of your default risk measures to kind of the spread of your infection rates. Now, obviously, that raises the question of whether there's a particular threshold of fiscal constraints or debt to GDP, if you wish, that makes you particularly susceptible to shocks to economic growth. Now, that gets us to kind of trying to understand whether there are kind of some endogenous thresholds of fiscal capacity. So the first thing to look at now is what we can do. Rather than kind of running these linear regressions where we kind of interact the infection rates with the spread of COVID-19, what we can do, we can kind of look at the effects or the sensitivity of each individual country in our sample, right? So we have now, if we exclude the US, we have 29 countries here. And for each country, we can say, well, what's the actual sensitivity given its fiscal rank and given the estimated relation, and is that relation significant? And so what you see quite quickly is that, well, for 20 countries, we have a sensitivity that's significant, right? And it is non-linearly increasing here. And for about, I think, 15 countries, we have an effect that's a sensitivity that's significant at the 1% level. So the question then becomes, if you look at kind of this particular country here, you can do this for the aggregate measure of fiscal constraints, or you can do it for any individual measure of fiscal constraints that we look at. You can just naively look at, well, what's the debt to GDP ratio, right, so to speak, if you focus on that measure of that particular country. So that gives you kind of a naive threshold that would say, at least based on our in-sample evidence, is there a threshold or where you have a kink in the sensitivity where you kind of more severely kind of impacted by any external shock as reflected in your sovereign CDS premiums. So what we're going to do is now for each measure, we're going to then look at, well, what is this threshold? And so that's what I'm trying to do here. So there's a lot of information, but just bear with me. I'm only going to focus kind of on those two rows here that are kind of highlighted in pink. So like I said, for the sake of the argument, just kind of to highlight this, the key insight here is to look at debt to GDP. So like I said, if I look at the first country where the sensitivity becomes significant, well, it turns out that country has a simple threshold of 60.8% of their GDP. Now that's quite interesting because it's kind of remarkably close to kind of what has been set in the European Union as the Maastricht criteria, beyond which you can get penalized if you kind of, your debt threshold kind of go beyond that level. Now, of course, doing this for each kind of measure is quite a naive way and is not very scientific. So what we're trying to do then is to follow kind of earlier work by Hansen to try to oops. Hello?
We can hear you, Patrick. All right, looks like we have a technical difficulty. We have a backup plan and we should be running in a few minutes.
Hello?
We can hear you now.
Okay, I'm sorry I have a technical issue, but just the slides are gone. So would you mind just putting up the slides? Apologize
yeah,
for that.
I'm working on this. We'll be up in a second.
Apologize to everyone.
It's that bad Luxembourg internet.
It is. That's what I was afraid of.
All right, let's make this full screen. All right, so I think we're somewhere.
Yeah, and the endogenous threshold levels. If you go on, I think it's slide 14.
Mm-hmm. Next one, right? You did the regression?
Yeah, yeah, it's continuing. I just see like a fixed screen right now. I see slide 7.
Well, it's now on 14, so it's a big regression with delta CDS and.
Okay, for some reason I can't see this one.
Dima, I don't think we're seeing what you're showing on your screen. We're still seeing slide 7.
Oh.
There we go.
There we go, yeah.
I think the full screen doesn't work so for me, so that's why I'll just do it this way.
Okay, so we have 17, 16.
Yeah, I have 16. So.
Next one, yeah.
Yeah, that's the one.
Okay, that's it. So I'm terribly sorry for this this mishap. All right. So let's continue. So like I said, so you can basically take this very naive approach of trying to identify these thresholds for each individual measure, which in particular for the debt to GDP ratios turns out to be 60.8%. Or you can say, well, let us kind of do a bit more scientific approach and look at these endogenous threshold regressions based on Hansen in Econometrica in 2000. So ultimately, what is the idea here is kind of to try to say, well, there is a relation between kind of CDS and the infection rates, but there might be essentially kind of a particular level of some fiscal constraints beyond which there is a kink in the sensitivity. So where you have kind of a different sensitivity that is significantly different from that one below the kink. And so if you do this using kind of the endogenous threshold techniques, what you get is what you see in column 4, actually in the row highlighted in pink, and which is also 60.8%. Now, magically, in this particular case, this number turns out to be exactly the same, which is not cooked up, to be upfront. So because you see for all the other kind of measures, these numbers are not necessarily the same. Now, just it turns out that magically for debt to GDP, the simple threshold actually coincides quite exactly with the endogenous threshold measure. And so then if you look at the distribution, well, that tells you kind of, well, at this threshold, if you're below that, so we have about 15 countries below that threshold, 14 countries above that threshold, as shown in in column 5, well, then the sensitivity, which is the beta low, shown in kind of column 6, is 0.012. And the sensitivity high, right above the threshold, is 0.68. So kind of the sensitivity of kind of your sovereign default premiums to kind of economic growth shocks, so the infection rates, increases about 5 to 6-fold, right, from below the threshold to above the threshold. And as shown in kind of column 8, that effect is also statistically significant. Now, like I said, you can do this for each measure and ask yourself, are these endogenous thresholds that are significant? And for all of these measures, you will kind of find such a significant threshold. Now, you can also go beyond this and say, well, I'm trying to see if there's a second threshold beyond which there's another kink. And so that's kind of what we have in panel B. And again, not to bore you too much, essentially what you get is that conditional on having established the first threshold, which was the 60.8% for debt to GDP, well, you can ask, well, is there a higher threshold, as shown in column 3, that is where we have a second kink in this sensitivity. And so in this particular case, it turns out to kind of have a measure of 102.2%, beyond which we have another threshold. And that's roughly in the ballpark of what was kind of put forth in the debate between Harder and Rogoff and subsequent kind of papers about their kind of threshold regressions on debt to GDP. Now, again, their debate was about debt to GDP explicitly, whereas we kind of essentially are focusing on various kind of fiscal constraint measures, as well as on an aggregate measure of fiscal constraints. Now, if you kind of now look at well, now because we have 2 thresholds, we're going to have 3 sensitivities, a beta low, a beta medium, and the beta high, right? And you see that individually, all these kind of sensitivities are significant. Going from beta low to beta high, you have the same kind of increase. It's about a 5 to 6-fold increase. Going from the beta medium to the beta L, you have about a kind of a 2-fold increase. And so, as we had before, right, kind of the beta medium to beta low is significantly different, whereas we cannot find a statistically significant difference essentially between beta high and beta medium. But that said, kind of there's of course a lack of power here that we're having. But again, this is suggestive essentially for all these measures that of having kind of endogenous thresholds around which you get a kink in your sensitivity of default risk to effectively your infection rates. All right, I think we can go to the next slide. Thanks. So the last question then kind of that we're trying to address here, because we're kind of trying to argue that the fiscal channel or your fiscal capacity is a main amplifier in your sensitivity of sovereign default risk to kind of external shocks that you get. But of course, you might be concerned that we kind of have confounding effects because there was kind of significant monetary policy interventions during the pandemic. So some countries actually had kind of lots of bond buying. So if you take kind of CDS kind of premiums as a first order proxy for borrowing costs, well, that actually might be kind of kept down by the bond buying interventions. You might also say certain countries do not have independent monetary policy, like countries in the Eurozone, essentially, and therefore their effect is actually amplified. So it's not really clear whether we're clearly kind of capturing a fiscal channel or perhaps some combination of a fiscal and monetary policy channel. So to somehow address this, what we're doing, we're going to repeat the same analysis as we have done, focusing on 2 subsamples where effectively monetary policy can be held constant. The obvious one is just a sample of 16 Eurozone countries where I've already shown you before the evidence that kind of the results go through, and they're kind of similar in both subsamples.
Patrick, let me jump in for 1 second and let you know, I know you lost a few minutes with the technical problem, but we have a hard stop in 10 minutes.
Okay, so let me kind of try to be very quick here and get close to the kind of conclusion. So just to say, we're repeating this analysis for our US states, where we're going to add unfunded pension liabilities as another measure. And so there you have the ranks of the US states, which go from Texas being the least fiscally constrained to New Jersey and Illinois being the most fiscally constrained. And so on the next slide, we kind of repeat the same kind of regression analysis that we have done for countries. And without going too much into details, the short story is kind of we find exactly the identical effects, kind of on an economic basis, they're very similar. The coefficients look different because we're doing this at a weekly frequency rather than a daily frequency. But again, we see that within the US, across US states, if you kind of fiscally sound, countries like Texas and Florida have an insignificant sensitivity of their CDS premiums to infection rates. And that's even true in the current period. So yesterday we verified this analysis to see what it's told for right now. And whereas if you have fiscal constraints, like Illinois, for example, you actually have an extremely high sensitivity of default risk to incidence of infections. All right, so I think that gets us to the robustness, I think, which we can skip. And then I think I can actually directly skip to the conclusion to keep it short for a discussion. So overall, what we're trying to do here in this paper is we think that the pandemic, even though it's very unfortunate on a humanitarian basis, we think that it presents actually quite a unique setting to help us understand how fiscal capacity might play a role in modulating the relation between shocks to economic growth and sovereign default risk. And so what we find, the big picture or the big headline takeaway message is that fiscal capacity is actually amplifying the exposure of sovereign credit risk to systemic shocks. So what do we find? Well, we find that their CDS premiums of countries increase significantly to COVID-19 infection rates, but only if they're fiscally constrained. And obviously the flip side of this is that if you're a more fiscally sound country, you're much more resilient to external growth shocks in terms of the reaction that's like how financial markets penalize you in terms of CDS premiums. And of course, if CDS premiums are first order proxy for borrowing costs, well, that affects your access to capital markets to some extent and the interest cost that you have to pay. Now, we feel that this has important policy implications that might be obvious, but that have been subject of intense debates, not least in the global financial crisis, but that I think will continue to be important in the policy debate, given the continued discussions in the press that we have these days. So obviously, I think it shows the need to unlever the public balance sheets and increase fiscal capacity when we have good times. I think the analog of this is for banks is to have macroprudential financial regulation, right? That's takes advantage of cyclicalities. And of course, the flip side of this issue is that, well, if you just happen to to need to roll over your debt, right? So when you a crisis hits and you being penalized by financial markets in terms of borrowing costs, simply because you happen to be at a higher level or low level of fiscal capacity, well, the risk premium that we have to pay is so significant that I think in such times, it actually justifies a role for fiscal solidarity. That's it on my end. So thank you very much. And again, apologies for the logistical hiccup.
All right, thanks, Patrick. So there was a lot of discussion in the chat while you were talking, and it seemed like your co-authors were working hard to answer the questions. So I'm not gonna read all those questions because I think a lot of them were answered, but what I'll just do is invite anyone who wants to ask a follow-up question or wants to, who feels that their question wasn't fully answered or who has a different question, to unmute themselves and ask their questions via the microphone. And while people are thinking about their questions, I'll raise the issue that was bothering me, right? So your key right-hand side variable is Delta COVID, or else Delta COVID interacted with other things. Mm-hmm. But it's hard for me to view Delta COVID as exogenous because it depends upon the policy reactions. Right, and then the policy, depends upon, say, South Korea's policy reaction to COVID. And maybe that's correlated with South Korea's fiscal position.
So you're saying because, well, that's the fiscal support packages you're getting, right? So that you're speaking about. But that's part of the argument that we're making at the beginning, that many of these fiscal support packages actually came much later. So for example, in the EU case, so actually to be very frank, I'm not as familiar with the fiscal support packages.
No, I'm not talking about fiscal support packages. I'm talking about their policy reactions in terms of, whatever, medical or interventions to reduce the infection rate. I mean, to be very simple, maybe bad countries that were bad in terms of their fiscal position were also bad in reducing the infection rate.
Well, that's what we're trying to mitigate, right? Which we're arguing is not the case, right? That's what we're trying to kind of mitigate by looking at these kind of like cross-sectional variation in the state of your healthcare system, and essentially say that the number of doctors you have per patients in terms of the fraction of your obese population. Like, but in particular, kind of what you were talking about is the healthcare system. And so that's where we kind of clearly show that this is not much correlated with kind of the ranks of fiscal capacity. And also it's not able to kind of explain cross-country variation in these reactions, nor is it essentially kind of driving out the impact of fiscal constraints. And so the second point where you're saying, so I take it, and I think that's a very fair point, that the subsequent evolution, right? So the way you flatten the curve, right, might essentially be kind of correlated with policy interventions, that's for sure. But I would say at least the very initial starting point, I would say kind of, you can more closely say that I think that's actually kind of exogenous, right?
Okay. Anyway, I'll shut up now and give other people a chance to ask questions.
Hi, Patrick. This is Sang.
Hi, Sang.
So I already asked the question, but I was disconnected, so I was not able to see the chat. But how does the fact that different economies are interconnected through trades, like for example, a big negative COVID shock to the US or to China might serve as a big negative shock to South Korea, whose economy heavily relies on trade?
Yeah, so I think, again, to some extent, let me think about this for a second. So that one is a good one. Yeah, we haven't thought about this. David, you want to intervene?
Yeah, no, I think it was a great question, and I think it's definitely something we can check. So the easiest way would be, for example, have some sort of like trade over GDP amount, and then use that interactive with the COVID as well on the right-hand side, and that would address your question. For that to be driving our results, you would need to have a strong correlation between fiscal capacity, so for example, debt to GDP, and reliance on trade. And I think I would have a hard time imagining that necessarily in the sample of 30 developed economies. Definitely if we had developing and emerging economies together, that could be the case. But only for developed economies, I don't have that prior list, but it's definitely something we can check by adding that further.
Yeah, I thought that was an important factor because in one of your figures, we saw that the case numbers were going up a lot in the US and in Europe, but CDS spreads of Asian countries actually went up a lot more than such countries. So I was wondering if there's anything, something similar going on in your data. Yeah, but thanks for your answer.
Yeah, and also we have that sample of US states, which I think don't make the same kind of trade argument for that. But it's definitely something that we could, add as a robustness.
Thank you so much.
Yeah, I think just to follow up on this, I think actually the best answer is, and I spent least amount of time on talking about this issue, is indeed the evidence we have on the US states, right? Because we literally have kind of an equivalent sample. Now, of course, you could push this off trade across states. But again, I think it's a substantial difference in terms of exposure to international trade linkages that we have seen from the international finance literature than what we could do. But it's like, I agree with David. I think it's something we should actually focus, check.
And I think it was Neil's comment on the policies, how the policy was implemented, right? If I didn't get it wrong. And I think that's definitely something. So one thing we did is, for example, looking at how many days since the pandemic has started, and check if that is driving our results, because you could expect that the big lockdown only comes a month after the beginning of the pandemic, and that's not what's driving our results. However, one thing that we didn't do, which I think is interesting, there's a colleague of mine who has this paper on compliance with social distancing norms, and how that varies by the individualistic nature of the culture of each country. And so you could argue that the same lockdown in China and in the US would have a very different effect because people comply to different extents. That's again something that we can definitely check and borrow up on that paper, just take their measure, put it in, and then see what happens. But again, I agree with Patrick that because we're looking at the very first beginning of the crisis, we're not kind of picking up all that policy changes and social distancing norms that were included afterwards.
Yeah. And so again, I think also to some, again, it's not a fully satisfying answer, but to the extent that is kind of the way you would implement a lockdown, that again would kind of depend on fiscal capacity to some extent, is actually also, if that's not changing over time, right? If that's just going to be attitude towards lockdown, I think that would be something that would be also absorbed by country fixed effects, right? So, but again, I understand it's not fully satisfying, but it adds to the points that potentially mitigate these concerns.
All right, thanks. Are there other questions?
I mean, I'm wondering whether this has effect on the term structure of CDS. So, because the shock is presumably relatively temporary, so it will be like 2 years, 2.5 years. So if we use like long-term CDS versus short-term CDS, do you expect to see different effects there?
So we haven't looked at this at all. So it's something I would like to look at, right? So, but kind of was the very short nature of our study where we tried to kind of push this out when things happen. So we didn't look at the term structure stuff. What I could do is to kind of to think it to the lens of my own job market paper, right? The model where kind of I can think about country specific shocks versus common shocks, right? Essentially, and how that might drive the term structure. So in this particular case, I think what we see is that there are country-specific measures of infection rates, right? And also these are effectively not driven out by any time trends. So to some extent, we kind of actually purging out any kind of common variation across these countries. So we're kind of arguing we're capturing a relation between country-specific kind of shocks and the sovereign risk measures, right? And so to the extent that these shocks are not priced, I would actually kind of expect a flattening of the curve. Now, I think there's also papers. I mean, you have kind of so Niels colleague at Illinois, right? Tim Johnson has himself a paper on kind of unpriced systematic shocks, right? That might be that have pricing effects. But as long as kind of we're thinking about the shocks not being priced, we should see a flattening. If they also have kind of a risk premium effect, that shock specifically, we might expect a steepening, right? But it's something interesting to look at, certainly.
Yeah, I think it also arches back to one of the questions we received, whether we thought this shock as being a shock to growth or to sort of like expected future growth. So this kind of tenor effect of different nodes in the curve is not something definitely that we looked at. We just, take straight up 5 years and that's it. But it's definitely kind of an avenue that we think is very interesting. So the timing dimension of it.
All right, other questions? In that case, I guess not. So in that case, I'd like to thank everyone for attending. Next week, we have a completely different paper. It'll be presented